Last week, I read an article about bringing unsecured credit on chain through stablecoins. It was written by the CEO of Codex, actually. And I found the concept to be very interesting and wanted to dig a little deeper to understand like how bad the unsecured credit market is in TradFi world.
Mhm.
And turns out like it's way worse than I imagined what it would be. Like we have done similar deep dives in the previous episodes about the Swift system and about fractional reserve banking in
Mhm.
the emerging markets. And in both of those cases, we came to the same conclusion that stablecoins could completely change how these systems operate and how much faster and more efficient the stablecoins can make those systems be. The credit cards market has actually seen very little innovation in the last 30 or so years. The tech stack is antiquated to say, like at best antiquated and dangerously unstable, actually, at worst. Think of it like this: it's basically groaning under the weight of its own efficiency, like opacity, exploitative practices. Consumers are underwater in high interest debt while paying off like record high APRs. It's basically funding a system that's run on opaque securitization and exploitative fees. So the whole situation is less than desirable, to say the least. You know.
Now, while you're talking about this, like we all have credit cards, right? We know the APRs are high, but why do you think the 1.2 trillion market is like unstable? What's actually broken that we don't usually see?
So okay, I will tell you where the market is right now. Okay, like right now TradFi is at a breaking point. Maybe it's a hyperbole to say it, but that's what it seems
Mhm.
like where it is. Consumer card debt is at a record high, over like 1.2 trillion dollars, with some reports even placing it above 1.3 trillion dollars. And simultaneously, the average APR on interest accruing cards has hit an all-time high, hovering between 22.25% to 23.99%.
Damn.
So yeah, things are not good. On top of that, if you look at the spread, the spread is at the highest level ever recorded. Uh, this is a clear signal that the market has reached an inefficient point, to say the least. And regulators have caught on to the practices, the sneaky practices that credit card companies actually do on a regular basis. So very recently, the CFPB came up with a new rule slashing late fees from an average of $32 to $8, which is like this actually is cuts into a $14 billion revenue stream that this credit card companies had going in their favor. But the force of nature, basically, like the winds are shifting right now in
Right.
terms of regulations and where things are coming from. So this is where we stand. And if you look at like what are we talking about in terms of bringing the unsecured debt market on chain, is like, can stablecoins really is stablecoin a viable option? Can stablecoins really pull it off? And like, look at where the stablecoin market is right now. It's a multi-hundred-billion-dollar asset class.
Right.
It's not a niche crypto asset anymore. Like, and it's being integrated by incumbents like Visa, Mastercard for settlement. And it's basically widely acknowledged that stablecoins are here to stay, and stablecoins are viable enough for giants like BlackRock to actively adopt similar technologies. And we are already seeing like really viable stablecoin product in the stablecoin card market. Like, we have in the stablecoin debt market in general, actually.
Mhm.
We have like Goldfinch, Teller, and we have card issuers like Rain. These are like they are originating real unsecured credit on chain and proving how the model works. So what I want to do with this episode is I want to break it down into three distinct sections. One is like deconstruct how bad the system right now is, and once we have discussed that, I want to like present a solution, like how stablecoins can solve the market that where we are right now, and how it can make the unsecured credit market even better, like much more efficient, much more faster, much cheaper. And there are obviously a few conflicts, a few risks that comes with the new system. So we'll get into those in depth as well.
Mhm.
So yeah, so let's take a look at let's take a look at where the market is. Like the core thesis of this episode is the consumer credit market is antiquated, opaque, and exploitative. So how is it, like, why I am saying that? Like, why the CEO of Codex saying that this is basically a fattened lamb? So the scale of the problem is like staggering. Americans right now hold a mountain of credit card debt. Right now, as we discussed, like the New York Fed reports estimate that the debt is around 1.2 trillion dollars. There are other reports that say the number is even higher. However, this basically shows that there is a 57% increase in the last 4 years, up from the 770 billion dollar pandemic low in 2021. And the cost to carry this debt for consumers is right now at an all-time high. The APR is like back in 2023, the APR was at 22.8%. Now it's even higher. And the median average is at about 23.99%. This has been the highest that it's ever been. Like the Federal Reserve started tracking the data back in 1994. It's the highest since then. And this is not just basically the reflection of the Fed's raising interest rate. And now they're lowering it. The interest rate has pretty much stabilized at about 4%. But if you look at the spread between the prime rate and the APR that they charge to the consumers, this is also at a record high. The prime rate is about 7.5%, and the APR is 23.99%, about 16 percentage point difference. So the system is not just passing on the cost, it's also widening. The credit card companies are widening their profit margins to historic levels. Like we have never seen this kind of exploitative practices in the past. How are they doing it? They are primarily doing it with two fees. One of them is the penalty fee, which is basically what you get charged when you don't pay your debt on time. In 2022, credit card issuers charged consumers over $14 billion in late fees alone, and these fees are not only a significant cost, but it also disproportionately affects like the subprime the borrowers basically. If you look at the difference between subprime and superprime accounts, subprime accounts were paying an average of $138, whereas the superprime accounts were paying only around $11. So, like, if you are not disciplined with your finances in this economy with the credit cards, you are going to get hammered by credit card companies. That's just a fact right now. So this actually, and right now, this revenue model is under direct regulatory assault. As I mentioned in the last section, the CFPB has finalized a rule
Right.
slashes the typical late fee from an average of $32 down to $8. So this basically this removes a major pillar of the industry's junk fee revenues. And then there are interchange fees. You can basically call them swipe tax. This is basically the invisible tax on all commerce. Just in 2023, these fees set by Visa, Mastercard, they cost merchants and consumers $133.75 billion. So every time a card is swiped, right, the merchant pays a fee of approximately anywhere from 1.3% to 3.25%. And this cost is obviously passed to the consumers then. So the credit card company charges the merchant, so the merchant has to charge the buyer, the retail basically, to get their money back through goods and services. So that's
Also,
where we
like
are.
I was reading about asset-backed securities recently, and it looks like it's a really inefficient way of moving credit from one place to another. Like, can you break it down, like how it really works?
Yeah, absolutely. So that's where like this is the relationship between merchant and the credit card issuers that where we are in the previous section. Now that like let's get into how the securitization works. So this is the final piece of the broken puzzle. This is the funding model. Like banks traditionally do not hold all the credit they issue. They will bundle thousands of credit cards receivables into like complex bonds, and they call it the asset backed securities, ABS, and they will sell it to large investors. So this is like they are converting this asset into securities. So this is the securitization process, and this securitization gets the risk off their books and gives them fresh capital to lend. However, the problem with this is like the engine here is she's seizing up. Like post financial crisis regulations have made this process like way more difficult. Like this, the share of credit card receivables financed via securitization has pretty much collapsed. Like from 2000 to 2009, this channel funded about 31 to 39% of the balances, but back in 2021 the figure plummeted to just like 5%. So this is basically the critical non-obvious linchpin of the entire problem, because banks can no longer efficiently spin this risk off from their books to someone else, like to capital markets. Now they are forced to hold more of this unsecured consumer debt on their own balance sheet, and holding this risk is obviously capital incentive
Right.
intensive and inefficient. So to compensate for this concentrated risk and inefficient funding, they have no choice but to charge consumers like record high margins. So
Right.
this is the old system at a breaking point. So since they cannot fix A, they're putting more pressure on B. Since they cannot really like effectively securitize their debts, they have to charge more and more fees upfront from the customer. So that's where we are right now. Now, this is where the new parallel system comes into place. It's helpful to break the crypto solution into two parts. Now, we have the Rails, the payment network, and the engine, the credit creation protocol. Now, let's cover the Rails first. So, you have a stablecoin like USDC, USDT. It's a digital token on a blockchain pegged one to one to a fiat currency like the US dollars. So, that's basically what a stablecoin is. And now, how does how does it work as a Rail? So in TradFi, a credit card transaction is a complex IOU that takes like 2 to 3 days to finally settle between banks. In DeFi, a stablecoin transaction finalizes in seconds, and it happens all the time, 24/7,
Right.
365 days. And the fees are like a fraction of the cost of what credit cards cost. And this is no longer obviously a niche market. The credit card, the stablecoin market cap is about $300 billion plus right now, and approximately 10 million blockchain addresses like wallets make stablecoin transactions every single day. So credit stablecoins are no longer a niche issue. Stablecoins are viable. Stablecoins can actually solve the problem,
Right.
and legacy incumbents are completely like fully on board with the stablecoin as a solution to these problems. Like Visa and Mastercard, they're actively partnering with stablecoin issuance and wallets to enable on-chain payments and settlements. This is something that we have discussed again and again in previous episodes. So this is the Rails point is settled. We know the payment network works now. The primary issue is the engine, where the credit creation, the credit is will be created. So the engine is a set of smart contracts. So that will be using stable coins as a rail to do what the bank does, which is underwriting and establishing new unsecured credit. And instead of going to an opaque ABS market, the on-chain engine gets its funding from a transparent liquidity pool. So imagine this: like anyone in the world can deposit their stable coins, like let's say USDC, for example, in a smart contract pool to earn interest. And that pool is based on the rules written in the smart contract. So the parameters are clearly
Right.
defined within that smart contract. So the entire loan book, like who borrowed, who supplied, at what interest rate, and the defaults, these are all public, auditable in real time. And this market right now is also reaching in scale. Like just for example, in August 2025 alone, the on-chain stablecoin lending volume was at about $51.7 billion, which is obviously not as big as the TradFi market, but it's not nothing. And this is pretty much all of this DeFi credit creation is pretty much dominated by Aave, Compound, like these DeFi protocols, and all of them are still dominated by over collateralized lending and borrowing infrastructure. But there is a way that we can go from creating secured, like over collateralized loans, to creating unsecured loans. So let me give you a few companies that are doing it in some ways. Like one of the most prominent example is Rain. Now, Rain is a global stablecoin linked Visa credit card issuer. So to the end user, Rain looks and feels exactly like a normal card. It's accepted
Right.
by 150 million plus merchants. And Rain as a card issuer, what they do is they have a classic working capital problem. They have to settle with Visa daily for all the cardholder purchases, but they only get repaid by the users at the end of the month. Now, traditionally, they would need that would be like an expensive process. It will be like a slow revolving credit line from a large bank. But instead, what Rain does is they use on-chain protocols like Credit Coup, where what they will do is they will tokenize their future cash flow. And this token is like represents a claim on the future cash flow that Rain is going to have, and this is placed in a smart contract as collateral, and that collateral is then basically used to take it basically get debt. And this allows Rain to instantly borrow stable coins from global liquidity pools to cover their daily settlement requirements with Visa. And this model is working, obviously. Like Rain has already borrowed and repaid over $175 million in USDC via Credit Coup, and this activity is accelerating how their card app adoption is growing. Like they are one of the fastest growing on-chain cards in the ecosystem right now. And so that's Rain. And then there's another one that's called Goldfinch. Now Goldfinch is actually uh, quite an interesting protocol in terms of how they are handling this on-chain credit creation, which is like Goldfinch is they're obviously a decentralized protocol that does this stuff. And how they do it is they create two classes of lenders. They have created this thing like backers and liquidity providers. Backers are junior tranche. That
Mhm.
means like they are active lenders who vet real world borrowers, like and they have to invest their own money as first class capital. So this is some sort of like a skin in the game system that they have done. Like if
Right.
money is to be lost, the backers lose their money first. And then you have like obviously in return what you do is you get a higher reward. Like so basically
Mhm.
if you want to pay money as a backer, like if you want to yeah, invest in the system as a backer, you get a higher reward. And you
Mhm.
have to bear like the higher portion of the risk as well. And then you have liquidity providers, which is like you have these liquidity providers are passive lenders who will deposit USDC into one large senior pool, and the pool smart contract automatically allocates capital to the borrower pools that the backers have already de-risked. So this is obviously again like the risk is lower here, so your reward will obviously be lower as well.
Right.
So this is a uh, quite interesting system that they have in place, and I will be really interested to see how this ends up, like how well this ends up performing.
I understand your point, but what I'm having trouble to grasp is the entire TradFi system runs on a credit score. Now, how do you lend to someone without collateral and without a credit score?
That's actually the most important question that we have to answer. Because like that's the same question that I had when I first read the article by Hauner. Like how do you solve that problem? Like the credit score is the monolith that decides everything in traditional consumer credit.
Mhm.
And how can a decentralized protocol replace all of it? Because like in DeFi, the credit score itself is not the most challenging part. Like you can track financial behavior through transparent wallet data. But the problem at the base is identity. Like
Right.
in DeFi, you don't really know who is who and who is interacting with what for what reason. So like when you are like the over collateralization problem solves one thing is that the protocol doesn't lose money, but it does. That's because it's over collateralized. Like identity is irrelevant here. If a borrower defaults,
Right.
the
Right.
smart contract automatically sells their collateral. And but with unsecured lending, a protocol must solve the civil attack problem, which like what stops one person from creating 1,000 wallets and defaulting on 1,000
Right.
loans. Like the solution is like there are obviously a few solutions that are in the making, and there are no one solution that's like set in stone that has to work. Like there are multiple projects working on this issue right now. Like there are a couple of models that I can talk about. Like one of them is the on-chain credit risk score, which analyzes a wallet's past borrowing and lending behavior. And like a different model might assign, let's say, a swap behavior score or a liquidity provision score to determine if a wallet is responsible DeFi citizen, basically. And the problem is this is a niche solution. It only works for crypto native users and cannot really score a gig worker or a small business
Uh,
new to the space. So that's one. Then there is another one, which is like this is I think the real breakthrough here is that like this model does not really try to replace real world data. It ingests it more efficiently and transparently. So like what happens with this new model is like this is an off-chain data slash like something like a hybrid model. You have like the killer application here is cash flow underwriting. Like instead of using a static FICO score, what you're doing is like this model connects to a borrower's actual bank account and uses AI to analyze their real-time income, spending habits, ability to repay, etc. Well, like really gets complicated. There are like
that sounds intrusive almost.
yeah, it does. It does to some extent, yes. But again, like when you are going to ask for a loan from a bank, they pretty much ask for everything, from your employment details to how like how responsible you are with your finance, etc., etc. So like lending and borrowing in general is an intrusive practice. So, for example, there was this white paper that FinReg Lab did, and they found this to be win-win. Like the study that I read, like they concluded that the machine learning models using cash flow data were the most predictive of any models and had the highest approval rate for like most subgroups, which basically means is like they thought that this solution could work. Like theoretically, it could work, but we'll have to see. And then there is obviously the trust-based system that Goldfinch is using. Like you have like people who are really expert, who really understands what they are doing, and they will put their money up first. And if something goes, like if there is a loss, then they take the hit, and liquidity providers don't take the hit in general. But that's like transferring the risk from like everyone to a concentrated group of people and increasing their reward ratio as well. So that's where we are right now. There is no one solution from where I am standing, and hopefully in the next couple of years we will get there to we'll get to a point where we have something that's viable, and that will help launch this unsecured credit market on chain.
This sounds great, but what happens when someone defaults? Like in the old world, a bank would usually send a collective agency. In the new world, what do you do? Like send a mean DM to an anonymous wallet?
Yeah, that's basically where we stand right now, right? Because like there isn't really any, since you don't know the person's identity, what jurisdiction they fall under, you can't really do anything. You don't have any legal authority over that person, because even even those kinds of lending borrowing practices are not legally recognized, at least not as of now. So I think the best uh, of both worlds will be a merger of the like the Onchain world as well as the TradFi world, where you KYC people. Like even if you want the advantages of having an on-chain system, like a completely frictionless instant settlement, very cheap loans, etc., etc. But on top of that, you want the trust and safety of the off-chain world, like the legal safety of the TradFi world. So what you do is, and obviously it goes against the ethos of crypto and decentralization and everything that it stands for, but like we are through the look or through that looking glass right as of now, so there is no point in discussing that. So what my suggestion will be, like for you to use any like a lending protocols or anything as such, you will have to KYC yourself, and as soon as you KYC, you fall under the legal guidelines and the jurisdiction of whatever area that you live in. And if that and basically that's how we solve the problem. At least that's how we temporarily solve the problem and bridge the gap. And from there on, we try to find better platforms and better solutions that will help us, that will equip us with the ability to basically collect from defaulters, or basically treat defaulters in a way that doesn't affect the actual lenders. Yeah, so that's basically where we stand. Like there isn't really a good answer to this question as of now, but the only answer is like we'll have to try and see where we go from here.